there are things that you could do with life insurance that you can't do with an index fund investment.
The risk profile is so vastly different.
What we don't know how to do is perfectly decide, okay, when do we want to pull back our exposure to this? 12.12%. So hooray. The big question is, can you beat the market with index universal life insurance?
Well, that depends on what market and what time period you're looking at. Let us pick the really good time period. No.
Hey.
Yeah, that's a loaded question, right? That has a lot of details sort of hidden beneath the surface. It depends on how you're measuring beat the market, I suppose.
So it depends on what your definition of is. Is that what you're saying?
Yeah, we went to the Bill Clinton School of Life Insurance Selling.
Yeah, so
it probably would have been better than any of the training that we actually got. So.
as a very quick primer for the newly joining us, indexing when it comes to insurance products are simply an interest payment that is based on movement in some sort of indice.
Right. You're not actually participating in the index itself.
Right. Right.
Just the movement.
So the 1 year change, for example, of an index S&P 500 becomes the interest payment with perhaps some sort of modification.
Yeah.
Because we could have a cap. So the movement in the index up to 10%.
Right.
Or something along those lines. So this gives you the opportunity.
We also have a floor.
Yes.
If it goes
generally
down 20%, you get zero.
Generally zero.
Yeah.
So the idea here is this gives you the opportunity to get a higher interest payment than you might be able to achieve in certain other fixed insurance products.
Right.
And some people look at that and say, well, gee, if I'm going to get the movement in the market like the S&P 500, that could put me in a place where I'll do basically as well as the market will, right?
Wrong.
Yeah.
Again, depends on what metric you're looking at, right?
Yeah. Yeah. So we want to kind of ground this by reminding people that fixed insurance products are fixed insurance products.
Right.
And the focus in terms of anticipated rate of return for something along those lines, fixed insurance products, it's going to compare favorably with bonds.
Yeah.
Compares incredibly well against bonds.
Right.
The stock market, no. There are some idiosyncrasies.
When we say bonds, we're actually talking about bond yields.
Yeah.
Because tracking price movements in bonds is
difficult
at best.
Now, there are some idiosyncrasies. There are some moments where life insurance products might look like they're performing better than the market over certain time periods.
Yeah.
If we take the lost decade, for example, that rate of return on the stock market was not great.
Right.
And if we look at life insurance, it compares extraordinarily favorably against it. But that 10-year period is not life in its entirety for anyone.
Was that 2000 to 10 or was that 2003 to 13? Or
it kind of depends on who you ask, but I think 2000 to the end of 2009 is kind of the general.
Right. Which is basically just to say that you ended up where you started.
Yes, because we had the dot-com bubble burst,
yep.
And then we had the
9/11.
Great Recession.
That happened.
9/11.
Yep.
So a lot of bad moments for the overall stock market.
Yeah.
Just falling in a relatively condensed period of time. That doesn't normally happen, by the way.
Right. Right.
So there are some people out there who want to continuously beat the drum that if you start factoring in taxable equivalent return and compare that to the stock market, life insurance suddenly becomes wildly more attractive. And I'm not saying that it doesn't at all, but there's still a lot of opportunity on the growth side with stocks that are probably going to put them ahead.
Sure. That's why we've done at least 3 different episodes in the past where people asked, which were done as a direct request from someone who listens or a client or something like that, where they want us to compare life insurance, index universal life insurance, whole life insurance to an index fund, a S&P 500 index fund. And we've always been very hesitant to do that because we're like, they're not made to do the same thing. So in theory, depends on length of time you're looking at, but in theory, the index fund's always going to win.
Yeah, and the other thing is it's sort of like magic in the sense that there's almost a misdirection taking place there.
Right.
Like when people ask about that comparison, oftentimes the way they want to set the goalposts is some randomized period of time.
Yep.
That takes money going into life insurance
right.
versus money going into an index fund.
Right.
and comparing account balances and declaring a winner.
Right.
Okay, but I don't understand what meaningful insight we gain from that.
Right. I was going to say, if that's your metric for success, we can stop the analysis early and tell you, hey,
which one do we think is going to have a higher rate of return?
We don't care.
Yeah.
Like if that's what your metric is, and we have to overcome that to earn your business, to convince you that this is a good thing to do, whatever, however you want to phrase that.
Yep.
We'll just stop now because
right.
we're not even playing from the same playbook.
The point from us all along has been the fact that there are things that you could do with life insurance that you can't do with an index fund investment.
Right.
And that is why you would own life insurance.
Right.
So maybe it's the fact that income that can be generated from a balance of life insurance as a withdrawal percentage, as an example, is generally higher than something that just sits in an index fund or even a target date fund.
Right. Right.
Because truth be told, when you own assets in that fashion, target date fund, index fund, you don't know really what you can generate for income.
Right.
I mean, we have a rule 4%, but it doesn't really mean much, and it's
not a rule.
highly suspect. So the ability to take life insurance and generate income from it is incredibly solid, stable. It reduces a whole lot of headache and worry about account balances.
Yep.
Or perhaps it's something like, I would like to have a pot of money that I can access at any time to do certain things. Maybe they be investment opportunities, maybe they be buy cars, whatever it is you do you. That, again, going to be difficult to do with an index fund, and going to be probably inadvisable with an index fund, because why give up the opportunity to continue to grow money inside that investment?
Right.
Life insurance, you don't have to give up the opportunity to grow that value inside the
take
policy.
A loan, still earn on the loan balance. Yeah.
Yep. So they function very differently. They have wildly varied attributes that are beneficial to them individually.
Right.
So we buy stocks because we want that accumulation.
Sure.
That can help do other things sometime down the road that we can't do with other assets.
Right.
That's cool.
Right.
But we also buy life insurance because that too brings a certain number of options to the table that we don't get when we just buy index funds.
Right. Exactly. Yeah. The comparison always baffles me a little bit because the risk profile is so vastly different between the two. It's like, it'd be like us starting or having a YouTube video where we're going to compare the 0-60 time of a Prius to a Porsche Carrera GT3.
Okay.
Which one's faster? I mean, do we really need to do the video? Do we need to do the test? I mean, obviously, if you're focused on which one has a faster 0-60 time, the Porsche is going to win every time.
Mm-hmm.
If you want to compare best overall, well, that's a totally different comparison that you're going to have to do a lot of testing and of different variables to determine.
Yeah.
And then it's going to be subjective, even with all of that. So
now the lack of potential analog there is just the fact that it's pretty impractical for a number of people to own both in a lot of cases.
Of course.
But theoretically speaking, if you wanted to be in a position where there may be some days where I need to get to work because I left 10 minutes late, well, one's going to be better than the other at that. Whereas there's other days that I want to go to the grocery store, I got all the time in the world, and I'd rather it be the most efficient use of fuel economy that I can have. Well, again, there's a different one that's going to be more indicated in that case.
Right.
So again, this is the point of the diversified portfolio here.
Right.
And there's the old philosophy that if a little is good, more must be better is not going to ring true here. So just because you think you're going to get whatever the rate of return is in an index fund doesn't mean that that is going to be the best option for you when it comes to building a secure retirement.
Right.
And when it comes to diversification, one of the problems on the subject of diversification is the fact that so many people do it so poorly because they don't really know how to do it.
Right.
And they especially don't know how to do it in the world of passive indexed investing.
Right.
Because now the answer is always put it in an S&P 500 index fund and leave it for many, many years and everything will be fine. In long-term speaking, yes, the growth trend is positive with that. Nobody, not even us, is going to argue that idea. We have no desire to convince you that the 20, 30, 40-year trend line on a passive S&P 500 index investment, whether ETF or index fund, is going to be positive and probably going to be pretty agreeably positive.
Right.
But what we don't know how to do is perfectly decide, okay, when do we want to pull back our exposure to this? Because the risk that it poses year in and year out for loss, which may have possible problems for us when it comes to generating income from it, that is a timing issue that you can't get right just as much as you can't get right when it comes to buying things.
Right. Yeah. Timing is universal. So yeah, it can work all the way around there for sure. Yep.
So people try to diversify inside the world of indexed investing en masse, right?
Yeah.
Like we have ETFs and index funds for bonds.
Mm-hmm.
And most of them are horrible.
And I would say that's a better analog to what we're talking about with index universal life insurance than it would be comparing stocks.
That's where life insurance would compare.
Right.
So the one thing that comes up pretty often with people, and I think they get very wrong, and at the end of the day, I don't know that it matters a ton, but we have heard a time or 25 people tell us, hey, I don't know that I want something like index universal life insurance because I already have a decent amount of money in the market.
Right.
So maybe I want whole life insurance because that's the better diversification play. And in totally absolute terms, okay, fine. There is truth to this. But the degree of the truth is where the details start to matter and it gets a little convoluted.
Absolutely.
Because the fact of the matter is, index universal life insurance is still much more a bond-like position than it is like if we're plotting it on a chart. This is bonds, this is stocks. Index universal life insurance is like here. Whole life insurance is probably here.
Right.
So there's all this gap between stocks.
Right.
But still, like that's really the breakdown.
Yep.
And if we look at long-term rate of return on bond funds, a lot of them are awful. Like
they're terrible.
Like we ran 2007 to 2020.
Which is how most people own bonds. Quote unquote.
Yes.
Like that's what we know because we've seen many account statements.
Mm-hmm.
Most of the time, there's some B&D living in there, or
which we've got right here,
or something else. But
yeah, so 2007 to 2023 year-end BND, year-over-year rate of return, money-weighted rate of return, if we're getting all technical on finance terms, 1.73%.
Yeah,
you probably could have, depending on how long we have interest rates where they are, you could have just bought money markets and done about the same,
and had no principal risk.
Yep. Now because
your value's gone all over the place in that thing.
Yep. You've had some negative years.
Yep.
Most of them were not awful until 2022. Then they got real ugly. But now we anticipate long-term year-over-year money-weighted rate of return for something like index universal life insurance to be somewhere in the mid to high fives.
Yeah.
As a percentage. That's generally what we are targeting when we look at these things. So that's a lot better than 1.73. And that's net. That's net of everything. So after all of the insurance expenses have been deducted from this equation, the net five and a half roughly is. And
we're actually assuming in that in those return numbers, you're assuming that the investment of BND is in a non-taxable account.
Correct.
Because if it's a taxable account, you have negative real return.
You do, because you have a decent amount of dividend income from that investment that plays into that total return that you'd have to pay taxes on.
Right.
Which is going to be true of any bond fund.
Right. And think about that. That's, what'd you say it was?
1.73.
That's with dividends reinvested?
Yes, that's with dividends reinvested. In fact, I can tell you by recalculating this real quick that in 2023, the amount of income generated by the fund is more than half of the annual contribution you're making to the plan, and represents, actually it's higher than that. Doing quick math while we are live recording. It's a fun part of the insurance. Almost 3% of the entire account balance is the dividend being received.
Yeah.
So it plays a big role in terms of year over year growth.
And you still got 1%.
Yeah.
Right.
So we don't have any of those problems with life insurance because all of the money accrues without a tax implication.
Right. No negative years.
You're right. So this is why life insurance is a great complement in that world.
Yep.
And we have a far better rate of return with it. Now, again, indexing, we could do SPY over the same time period.
Live math part 2.
Sure. SPY 12.12%. So hooray, that's a great result. We don't expect index universal life insurance to ever hit those sorts of numbers long term.
No.
So yes, again, the point is we have an expectation for passive indexed investing that we think could be quite great, and people should do it. And we got no qualms with that. The diversification play is not about buying bond funds. It's more about buying life insurance because it's got a better rate of return. It's got far more versatility in terms of what you can do with it. And it complements this plan of an indexed investing strategy in the S&P 500 incredibly well.
Yeah, it does. I think it's the more apt comparison. And based on my almost 24 years now, I have to always recalculate in my mind, going through various interest rate cycles. Rates were much closer to where they are now when I started out. Actually, they were a little bit higher probably. So I've been through several of these, and I've watched how bond funds have performed over that time frame.
Mm-hmm.
I've watched the same ones. So going back to some old open-end mutual funds, which no one buys anymore, but that have been around for forever. And it was always the case that we always described it as every time you watch the dividend go up, you watch the NAV walk out the back door. And that's the net asset value. So the underlying value of the fund always went down. And it makes sense because that's the way interest rates and the market values of fixed income securities actually works. It just never, pretty early on, even when I didn't really know much, I was looking at that going, I don't think I'm going to recommend that people buy that.
Deal.
Yeah.
Yeah.
Like they're going to be upset because of that. Yep. Understandably so. So, and look, we've got plenty of clients who are very sophisticated investors in their own right, aside from anything they do with us, who immediately upon seeing an illustration and understanding index universal life insurance or whole life insurance, it doesn't really matter, looked at it and said, oh, this is like bonds without the principal risk, to which we wholeheartedly agreed. Like, yep, you get it. You understand what this is. And to my knowledge, those people do not buy other fixed income sort of, I mean, not that I know everything they do.
I don't know why you would at that point.
Right.
I don't know why you would at that point. I mean, I suppose if you happen to be in a large position,
we're talking about younger people here. We're not talking about people who are retired, by the way. Like we should specify.
Though we have met people who hold bond positions that look at life insurance and say, well, I think I'd rather move it over there.
Right.
I was going to say, I suppose if you've got a large position somewhere in the market that you want to de-risk and it's just, you want to move it very quickly.
Yeah.
You could do something like municipal bonds for tax-free income.
Sure.
But with life insurance, if you own it and you've got a substantial position in it and you also own stocks, I don't know why you would ever necessarily need to change the position that you have in an indexed investment.
Right.
Unless you had some very specific goal to accomplish by doing that. Maybe it's to move into something more dividend focused.
Right.
That would be fine. But you do not need to make changes to the same degree that I think traditional finance has advocated as you get older if you've got a position like this.
Right.
Because the one thing life insurance also brings to the table, as you mentioned earlier, is a rock solid guarantee on principal protection.
Yeah.
So now the idea of moving to bonds but having to worry about losing value because of par value changes,
now you got to manipulate and worry about that and watch the market. All the things that many people are thinking they're not going to do when they're making a fixed income type of investment.
You can live in a world where you are blissfully ignorant of the whole concept of convexity and be
smacked by
incredibly happier by it.
Yeah, exactly.